the liquidity mirage mechanism, how altcoins are structurally dependent on Bitcoin's capital inflows, exchange solvency, and retail FOMO cycles, making them the first and hardest casualties when macro tightening or BTC dominance expansion begins. Long before any bull run materializes, you're watching your altcoin portfolio recover. The charts are green. Twitter is loud. Someone on YouTube is calling for a 10x by summer. And somewhere in the back of your mind, you feel it. That familiar pull. The sense that this time maybe you got in early enough. But what if the run you're waiting for is already being priced in? And the collapse is what comes next. Here is the data that most retail investors never see before it's too late. In the 90 days preceding Bitcoin's April 2021 peak, total altcoin market cap surged from roughly $400 billion to over $1.4 trillion, a 250% expansion in under 3 months. That figure sounds like a bull market. It wasn't. It was the loudest warning signal in crypto history. Within 6 months, over 70% of that value had been erased, not gradually, violently. Tokens that had traded at 40 crashed to 3. Projects with billion-dollar ecosystems became digital ghost towns. Yet, and this is the paradox, almost none of those investors thought they were in danger. They were watching green candles. They were calculating exits at 5x, at 10x. They were diversifying into the next narrative DeFi, GameFi, Layer 2's AI tokens. Here is what they didn't understand: the bull run and the collapse are not sequential events. They are the same event, viewed from different ends of the liquidity cycle. In 2026, the altcoin market stands at one of its most structurally precarious points in its entire history. Bitcoin dominance is elevated. Institutional capital remains narrowly concentrated. And the macroeconomic backdrop, high real interest rates, tightening dollar liquidity, and a Federal Reserve that has shown no urgency to pivot, is exactly the environment in which altcoins do not survive. This video is not about fear, it is about precision. Because the investors who understand what is coming are not the ones panicking. They are the ones positioning. Let's break down exactly why altcoins are set up to collapse before the next real bull run even begins, and what you need to do about it right now. To understand why altcoins are uniquely vulnerable right now, you need to understand 3 core mechanisms that most retail investors never learn until they have already experienced the loss. Altcoin beta and Bitcoin dominance asymmetry. In traditional finance, beta measures an asset's volatility relative to a benchmark. A beta of 1.5 means the asset moves 50% more aggressively than its index in both directions. Altcoins, by structural design, carry extreme beta to Bitcoin. When BTC rises 20%, mid-cap altcoins often return 60-80%. When BTC drops 20%, those same altcoins frequently fall 50-7%. This is not coincidence. It is a feature of the liquidity architecture. Bitcoin absorbs capital first. Altcoins only receive capital overflow, the speculative excess that travels down the risk curve after BTC has already moved. This means altcoins never lead a cycle, they chase it. And in a cycle where BTC dominance is rising, as it has been since early 2023, climbing from the low 40s to above 6% by early 2026, altcoins are not accumulating capital, they are hemorrhaging it. The liquidity crunch and exchange solvency risk, the collapse of FTX in November 2022, was not merely a fraud story. It was a structural demonstration of what happens when altcoin liquidity is synthetic. FTX held billions in liquid altcoin collateral. FTT, Serum, maps assets that had market caps on paper but zero real exit liquidity at scale. When withdrawals began, the entire structure collapsed in 72 hours. Over $8 billion in customer funds vanished. What most investors still don't grasp is that this risk has not been eliminated. It has migrated. Smaller centralized exchanges still hold altcoin reserves with opaque collateral structures. Altcoin lending protocols still use token-denominated collateral that becomes worthless the moment the market turns. The lesson from FTX is that liquidity is not the number on the screen. Liquidity is what you can actually exit at under real selling pressure. Tokenomics, the structural inflation trap. This is the mechanism almost no retail investor examines before buying. Most altcoin projects launch with vesting schedules, team tokens, investor allocations, ecosystem reserves, all locked initially, then released over 12 to 48 months. What this means in practice is that at any given moment in 2025 or 2026, dozens of major altcoin projects have hundreds of millions of dollars in insider tokens scheduled for unlocking. These tokens were acquired at seed or private sale prices, often 90% below current market prices. The holders do not need the market to rise to profit. They are profitable from the moment the unlock occurs. This is structural selling pressure that is invisible to the average retail buyer watching a chart. You buy. The team sells. The chart goes sideways, then down. You wait for the rebound. It doesn't come because the unlock schedule has months remaining. Combining these three mechanisms, altcoin beta asymmetry, synthetic exchange liquidity, and inflationary tokenomics, you get a picture of an asset class that is not just volatile. It is structurally designed to transfer wealth from late entrants to early participants every single cycle. Let's talk about the cost, not abstractly, but in real dollar terms. The 2022 altcoin bear market erased an estimated $1.9 trillion in total crypto market capitalization from peak to trough. To put that in perspective, that is more than the GDP of Canada, gone in under 12 months. The vast majority of that loss was not absorbed by hedge funds or institutional traders. It was absorbed by retail investors in South Asia, Southeast Asia, Eastern Europe, and Latin America. People who had entered the market in 2020 and 2021 believing they had found an asymmetric opportunity. The invisible financial loss here is not just portfolio drawdown. It is the opportunity cost of frozen capital, money that could not be deployed into inflation hedges, real estate, or productive assets because it was locked in illiquid altcoin positions that could not be sold without catastrophic loss. Ray Dalio has spoken extensively about what he calls the beautiful deleveraging, the idea that orderly debt reduction is possible when central banks manage liquidity carefully. In crypto, there is no beautiful deleveraging. When altcoin markets unwind, they do so through what I would call a cascade liquidation spiral. Falling prices trigger margin calls on leveraged positions, which trigger forced selling, which reduces prices further, which triggers more margin calls. The spiral does not stop at fair value. It overshoots it, often by 80 to 90%. The core fear mechanism in altcoin investing is not simply fear of loss. It is the FOMO to capitulation pendulum, the psychological cycle in which investors buy at euphoric highs because they fear missing the cycle, hold through devastating drawdowns because they fear realizing the loss, and then sell at the absolute bottom because they can no longer endure the pain. This pendulum is played out identically in every crypto cycle, 2014, 2018, 2022. And it will play out again because the market structure that creates it has not changed. What has changed is the scale, the number of retail participants, the leverage available on DeFi protocols, and the interconnectedness of the altcoin ecosystem are all larger than they have ever been. The question is not whether this collapse will happen. The question is whether you will be positioned on the right side of it when it does. Let me make this concrete. Let me show you what the altcoin collapse mechanism looks like at the personal portfolio level. If you held a basket of top 50 altcoins from November 2021 to November 2022, here is what happened to your net worth. Assuming equal allocation across assets like Loan A and AR of XL, your portfolio experienced a weighted average drawdown of approximately 83%. Not 20%, not 40%, 83%. A 50,000 portfolio became 8,500, and because many of those positions were held on centralized exchanges, you also faced the risk of exchange insolvency, meaning even that 8,500 was not guaranteed. Investors who ignored Bitcoin dominance expansion as a leading indicator experienced the full drawdown with zero warning. The signal was there. BTC dominance began rising in May 2021. Any investor watching that metric understood that capital was rotating out of altcoins and back into Bitcoin, the flight to relative safety within the crypto ecosystem. Those who acted on it preserved capital. Those who did not lost the majority of their positions. Now let's map the full anatomy of what an altcoin collapse does across 6 dimensions. Portfolio impact, drawdown magnitude in altcoins exceeds Bitcoins by a factor of 2 to 4. Correlation with BTC collapses to near 0 in early stages as altcoins fall independently, then spikes to near 1 as panic spreads, destroying any diversification benefit, career, and income. The 2022 bear market triggered mass layoffs across crypto native firms. Coinbase cut 18% of its workforce. OpenSea cut 20%. Dozens of DeFi startups dissolved entirely. Bonuses paid in project tokens became effectively worthless. Stablecoin de-pegging events, most catastrophically UST in May 2022, which went from $1 to near 0 in 72 hours, erased savings that investors believed were protected from volatility. The assumption of stability was the trap. Behavioral finance, panic selling at cycle bottoms, is documented across every bear market. Confirmation bias leads investors to seek out analysts predicting recovery rather than confronting contradictory data. Herd mentality accelerates both the run up and the crash. Risk perception, anchoring to all-time highs, is perhaps the most destructive cognitive bias in crypto. Investors who purchased at 60 on a token that previously traded at 200 feel they are getting a discount. They are not accounting for the probability that the token never reaches 60 again, or 0. Systemic blind spots, counterparty risk in altcoin DeFi protocols remains massively underpriced. Rehypothecation, the practice of using the same collateral multiple times across multiple lending protocols, creates invisible leverage chains. When one protocol defaults, the contagion spreads instantly to every interconnected protocol. Most retail investors have never heard this word. They are exposed to it daily. The beginning of the unlearning process is recognizing that most losses in altcoin markets are not caused by bad luck. They are caused by rational responses to irrational incentive structures, structures that reward early participants for distributing risk to late arrivals. Once you see this mechanism, you cannot unsee it. And that is the beginning of actually strategic investing. So what do you actually do with this information? The answer is not to panic. The answer is not to sell everything and retreat into cash. The answer is to build a framework that makes you antifragile to the outcome, whatever it is. Portfolio rebalancing and uncorrelated asset allocation. If your current crypto portfolio is more than 60% altcoins by weight, you are structurally overexposed to a single risk factor, altcoin beta. Rebalancing toward Bitcoin, which has demonstrated greater institutional adoption, spot ETF inflows exceeding 12 billion in the first year post-approval, and superior liquidity reduces this exposure without exiting the crypto asset class entirely. Beyond crypto, allocating 15-25% of an investment portfolio toward genuinely uncorrelated assets, short-duration treasuries, commodity-linked instruments, or T-PICE, creates a buffer that performs precisely when altcoins are in freefall. Volatility hedging for active traders, options on Bitcoin and Ethereum are now available through regulated platforms. Purchasing put options, the right to sell at a fixed price, allows you to profit from or be protected against downside scenarios. This is not speculative, it is insurance. For those who prefer simpler instruments, inverse ETFs tracking crypto indices provide directional short exposure without the complexity of options. Liquidity reserve management. The 3-bucket framework. Think of your capital in 3 buckets. Bucket 1 is your emergency reserve, 3 to 6 months of expenses in fiat or short duration stablecoins, never deployed into volatile assets. Bucket 2 is your core long-term allocation, Bitcoin, blue chip equities, real assets, held through volatility without leverage. Bucket 3 is your speculative allocation, altcoins, early stage projects, high risk, high reward positions, capped at a percentage you could lose entirely without altering your financial life. Most retail investors have no bucket 1 and an overweighted bucket 3. They are one bear market away from financial crisis. Stress, test your portfolio, take your current holdings and apply the 2022 scenario. Bitcoin down 75%, altcoins down 85%. What is your portfolio value? Can you still pay your bills? Can you still invest? If the answer is no, your position sizes need to change today, not when the market gives you a warning. As Nassim Taleb observed, the fragile wants tranquility. The antifragile grows from disorder. In crypto markets, disorder is the default state. The question is whether you are building fragility into your portfolio by chasing narratives or building resilience by understanding mechanisms. The goal of everything in this video is not to predict the market. It is to make you prepared for every outcome the market delivers. If this analysis gave you a framework you didn't have before, not just information, but a way of seeing the market differently, then like this video and subscribe. Every week, we break down exactly the kind of structural market intelligence that turns reactive investors into strategic ones. You deserve to be on the right side of these cycles. Let's build that together.